guest, JoAnne Bianco, is investment strategist, client portfolio manager at BondBloxx, joins us now. JoAnne, thanks so much for joining the show. Really great to have you.
Thanks for having me. Thank you.
So, JoAnne, I want to ask you, because the Fed has made it clear that interest rates are moving lower. Kevin Hinks was at the top of the show saying maybe not as fast as the market actually wants, but we haven't necessarily seen that play out in the Treasury market. We've seen a tick higher in the 10-year yield, including today. So just explain to me what's going on there.
Yeah, Treasury rates have backed up a bit since the Fed meeting, but that's really nothing alarming in our opinion, because if you look at, how big the move has been since the beginning of July, it's still a pretty sharp rally since if you look at it overall.
Okay, so strong month, strong quarter for the fixed income market. What comes next?
Yeah, it's been a very strong quarter for the fixed income markets, and it's increased the year-to-date gains in all the top performing sectors. And so we think that, there could be more of the same in the fourth quarter, that investors shouldn't wait necessarily to increase their allocation to fixed income. And in historical data suggests that adding to credit sectors or extending duration tends to outperform cash-like instruments in a Fed rate cutting environment. So we're telling our clients to focus on these resilient credit markets that we're seeing, both BBB and high yield corporates, and then also to move out in duration in U.S. Treasuries.
Okay, so let's talk a little bit more about what that looks like in terms of specific investment ideas. Starting with duration, you say move out on the yield curve. Just explain a little bit more.
Sure. I mean, if investors are invested ultra short or in other cash-like instruments, we're recommending that they swap out now to reduce their reinvestment risk in this declining interest rate environment. So if they're in like 3-month, bills or whatever, then we're saying just even start with our X-half ETF, which is a 6-month target duration U.S. Treasury ETF. But then if investors are interested in the potential for more price appreciation, they should go out further on the curve, maybe 3-year, 5-year, 7. We have ETFs for all of those time periods in our Treasury suite.
Okay, and then your next specific investment idea is prioritize income. How so?
So that's where we're still talking about investors adding to credit exposures. People talk about spreads being somewhat tight. Yes, but they're tight for a reason. They're tight because fundamentals are really strong in corporate credit, and they especially are benefiting asset class like corporate bonds, BBBs in particular on the investment grade side, because why not get the extra coupon income that you can get from BBBs. And so we have 3 BBB products, the short, intermediate, and long BBB ETFs. And so we're recommending that investors consider the intermediate exposure in BBBs, 5 to 10 year exposures, because we think that they'll be able to generate great income plus total return from price appreciation.
Okay, and then finally, tap into opportunities in U.S. high yield.
Yeah, and the high yield continues to be one of the best performing asset classes in fixed income, CCCs in particular. They're up over 11% this year. They still have the best yield that you could get in the public high yield market or across most of fixed income. And so you're in this supportive economic environment where we are recommending that investors continue to consider going all the way down to CCC credit quality, because we think that they're being paid for the risk.
Okay, so talk to me about your expectations for the Fed's next moves. We were talking about it at the top of the show. The market might want the Fed to get to neutral ASAP. Powell made it seem like, it could take a little bit longer. Between now and year end, how many more rate cuts do you think, or what are the size of the rate cuts that you think we'll see from Chair Powell?
I mean, we take them at their word in terms of their data dependency. So we will have a big number on Friday with the non-farm payrolls. We'll also have more numbers in terms of inflation before the November meeting. And so what they have indicated in the dot projections is another 225 basis point rate cuts before year end. If that's what our idea is that they would do. It's just if we could see much weaker data than expected, then maybe there would be another 50 basis point rate cut in there before year end.
All right, we'll leave it there. JoAnne Bianco, investment strategist, client portfolio manager at BondBloxx. Thanks so much.